Hey everyone, and welcome back to the channel. If you've ever looked at the stock market and thought, where do I even begin? You're in the right place. Today, we're breaking down how to identify a good stock to invest in step by step. It's not about finding a magic formula, but about building a solid, repeatable process. So grab a notebook and let's get started. First things first, you need to understand the big picture. I'm talking about the overall economic environment. Think of the economy as the weather. A sunny day is just better for everything, right? In investing, a strong economic backdrop usually means a rising stock market. So what should you look for? Check for stable or accelerating GDP growth. Is the economy expanding? Also, keep an eye on inflation. Low to moderate inflation is generally okay, but high inflation can eat away at a company's profits, making its stock less attractive. Interest rates are another huge factor. When rates are low, it's cheaper for companies to borrow money and expand, and it also makes stocks a more appealing investment compared to safer options like bonds. Finally, a stable political environment matters. Uncertainty can make markets nervous. So, if you see the macro outlook improving, good GDP, manageable inflation, and reasonable interest rates, the market as a whole starts to look much more attractive for investing. Next up, let's talk about valuation. Just because the economy is doing great doesn't mean you should buy anything at any price. Imagine finding the perfect house, but it's listed for double its actual worth. Bad deal, right? The same applies to the stock market. You need to ask, is the market currently overpriced? There are some key indicators you can use to figure this out. The most famous one is the P/E ratio, or price-to-earnings ratio. This tells you how much investors are willing to pay for each dollar of a company's earnings. You can look at the P/E ratio for the entire market, like the S&P 500. Then, compare this number to its historical averages. If the current P/E is way higher than its 20-year average, it could be a sign that the market is a bit frothy and future returns might be lower. Other tools like the CAPE ratio, which adjusts for inflation and business cycles, can give you an even clearer long-term view. The goal here is to get a sense of whether you're buying into the market at a reasonable price or at the peak of a speculative bubble. Okay, so we've looked at the economy and market valuation. Now, let's zoom in a little and talk about sectors and industry trends. Not all parts of the economy grow at the same pace. Think about it. Industries like artificial intelligence, green energy, and healthcare for an aging population are benefiting from massive, long-term shifts in our world. These are what we call secular growth trends. A promising sector often shows a few key signs. First, is there strong demand driven by a long-term trend? For example, the shift to electric vehicles is a huge tailwind for companies in the EV supply chain. Is the regulatory landscape favorable? Sometimes, new government policies can supercharge an entire industry. And of course, is there technological innovation? Breakthroughs can create brand new markets and leaders. By identifying these leading sectors, you can position your investments to ride a powerful wave of growth for years to come, instead of just hoping for the best. We get to the heart of it all, the companies themselves. A strong market is ultimately built on the backs of healthy, profitable companies. This is where you need to do your homework and look at the financial health of an individual stock. It's like checking the engine of a car before you buy it. What should you check? Start with revenue and profit growth. Are sales and earnings consistently going up? That's a great sign. Next, look at the balance sheet. How much debt does the company have compared to its cash flow? A company buried in debt can be risky, especially if interest rates rise. Another great metric is return on equity, or ROE. This shows how effectively the company is using its shareholders' money to generate profits. And a fun one to watch is earnings surprises. If a company consistently reports better than expected earnings, it's often a sign that management is doing a fantastic job. If most companies in a sector or the market are showing these positive signs, it confirms that the underlying foundation is strong. And that's our 4-step framework for identifying great investment opportunities. We started with the big economic picture, checked the market's price tag, identified strong industry trends, and finally, inspected the health of the companies themselves. By following this process, you're not just guessing, you're making informed decisions. Thanks so much for watching today. If you found this helpful, please hit that like button and subscribe for more content to help you on your investing journey. Let me know in the comments which sectors you're most excited about right now. See you in the next video.